Hey everybody, welcome to the morning market briefing. It's Friday, April 21st, 2023. Guys, giggle boxes are open. The giggle boxes are open this
I'm
morning.
telling you, we need a live studio audience because
I don't think we do. I don't think that'd be appropriate. Ben's been here for about 2 minutes. And it's just been a laugh fest since he got here. Fresh, clean. Did you work out this morning?
I did. I went for a run. I did my burpees, so got that done.
Ben is doing burpees in his office. It's always weird when you're sitting next to
it. I'm actually in a it's not a competition. It's a collaboration.
Blowing them out of the water
with one of our accountants, Jonathan McKay. We're doing 5 additional burpees every day for a month. So we did 80 today. Well, I did 80. He hasn't gone yet. So
challenge issued right there.
Indeed.
It's got 8 hours to finish.
Yep. So yeah, well, you'll have to keep us posted on the competition. Yeah, good for you guys. Let's jump in. S&P futures basically flat, Dow futures basically flat, NASDAQ futures down about 30 basis points. Let's open up with some economic data from the Eurozone and the UK. Ben, what are we seeing? Seems like a bit of a slowdown.
It's a bit of a slowdown on manufacturing side, as you might expect, but a bit of an increase on the services side, both in the UK and in mainland Europe. And I think that just is going to make all of these issues worse for them because it's just going to mean prices stay higher for longer. We already talked about the UK inflation earlier this week, staying constant at 6.2% on the core. Christine Lagarde was out yesterday, I believe, saying that they need to raise rates further. And I think that you're going to have to continue to see higher rates. Again, the UK was the first central bank to go, but they've also been the slowest to raise rates. The ECB was the last to go. In the middle was the Fed. And the ECB has gone a little bit faster than the UK, but they still have a ways to go also. So I'm curious to see what happens there. I don't know how. I mean, if the US struggles with high interest rates, I can only imagine how difficult it's going to be for the Eurozone to function with high interest rates, especially given how their economy is structured.
Yeah, they are far more reliant on floating rate securities for mortgages, cars. I mean, you name it. They have floating rate loans on almost everything, whereas we have primarily fixed rates over here. So the cost of living is going to continue to increase and really put the pressure on the general public in the Eurozone and especially in the UK.
Yeah, I think it's probably fool's gold because you'll see some of these European companies and European economies performing better. And the stocks are cheap. They're always cheap in Europe. And I think that you're going to have some people look to buy European stocks. We've already started to see it. But again, I think it's fool's gold because it only ends one way, and that's in rate hikes and a lower potential GDP growth than in the United States.
Yeah, I mean, theoretically, if you locked into a mortgage here in the US a couple of years ago, in the high 2s, low 3s, inflation is kind of your friend because the value of that note decreases every year. You lose 10% of the value, so it becomes easier to pay back as interest rate or as inflation goes up. But if you've got a floating rate mortgage, the rate at which you pay back your mortgage goes down really, really fast, and your monthly payment goes up really, really fast. So that could be potential for more credit issues over there as well as people start to default on their mortgages as rates get higher and higher.
Yeah, I think there's a day of reckoning to an extent with Europe. I mean, it's been kind of odd. I feel like even in the fall, we were talking about with relative surprise, the resilience we'd seen in kind of that whole Eurozone. And I think fool's gold is kind of the right term for it. I think there's challenges still very much ahead.
I mean, you're kind of seeing that with France. Yeah. I mean, the divergence between philosophies. I mean, here we sort of saw the issues with pensions, call it in the 60s and 70s, sort of made the shift to the 401k, sort of you put the retirement aspect on your own shoulders and you're responsible for your own coverage outside of, Social Security. Whereas in the UK, that's everything, or in France. And now they're starting to push back. They're saying, hey, this isn't working anymore. We're not going to be able to pay for everybody all the time, full salaries, for 30 years. And they're just trying to move it back 2 years and people are rioting. And additionally, they're not taking that money and investing it into their own equities, like we do every 2 weeks. If you're contributing your 401k or a profit share or some sort of, deferred compensation, that goes into holding up stock prices here. It goes into funding new companies.
They're just buying baguettes.
Yeah, they're just buying beignets.
We did get some earnings from individual companies, right, kind of in the throes of earnings season. Procter and Gamble up 2%. Pretty good quarter overall.
Yeah, it was a good quarter. And man, I'm just kind of breathing a sigh of relief. We got through today. This was a day of I was a little bit uncertain about, but Procter and Gamble kind of playing lead off here. They had pretty good price increases, and they're seeing really a reduction in those freight headwinds that they were having. A little bit commodity costs still an issue, pain point for them, but their pricing is up 10%. And that was really the theme of the quarter. They did get a little bit better volume than they got last quarter, but their volume was only down 3% this quarter. It was down 6% last quarter due to some inventory destocking. So it's down 3% this quarter. Price was up 10%. So I think analysts will be encouraged by what they would perceive as lower elasticity. And goods that are more inelastic. So I think it's probably good for Procter & Gamble at this valuation. It's tough to justify the current price. They did lower guidance for the full year on the EPS level, despite raising guidance on their revenue. So again, those costs continue to be a headwind. The foreign exchange continues to be a headwind. I think the big theme, however, is that as we get out of this fiscal year, the fiscal year ends in June. As we get out of this, you'll have continued declines in some of those commodity and freight costs and allow those margins to start to creep up again. And I think that's the bull case for Procter & Gamble here, but they do have to grow EPS. They haven't grown earnings per share for a year and a half now. So they need to get back on that train. Foreign exchange has been a big headwind, probably $1.30 per share between that and the commodity costs. But if they can get back to some growth on the bottom line, I think analysts will look at that favorably going into next fiscal year.
Yeah, it seems like they need something other than just pricing controls that they can be pulling. I mean, they've got margins or segments in which you're seeing, high single digits growth, but really no change in volume.
It's all
even
price.
Contraction in some cases.
And I think what it's going to require, and the problem, the setup for Procter & Gamble is tough too, because if you look into, they're going to guide conservatively. They always do. So next quarter, even if they have a strong quarter, which based on this evidence, they probably will, they'll probably guide conservatively, which could keep the stock largely range bound when you couple that with the valuation for probably the next 6 months. It's great ballast for a portfolio because it really doesn't do a whole lot and it pays a nice dividend. And it does generate nice returns on capital and good free cash flow. But in terms of driving idiosyncratic returns, it's probably not that type of stock. It's a great portfolio stock, not a great single name stock.
Yep. Regions Financial, another bank to kind of make it through this volatile period. Timing of the quarter end probably helped there to an extent. Net interest margin came in at 4.22%. Expectation was 4.1. Saw real stabilization in deposits in March. Quarter over quarter deposits only down 2.5%. So not a bad read there.
Yeah, this is kind of the reverse of Procter and Gamble. Regions is not a good portfolio stock, but probably a really good idiosyncratic stock because their deposits. I mean, I've gone through probably about a dozen banks now. Their deposit rate, the rate they pay on deposits, went up the least amount of any bank, and that includes Bank of America, Citigroup, JP Morgan, Wells Fargo. And now currently the average rate on deposits in Q1 was 0.91%. That compares with, just pick a bank, First Horizon 1.73, JP Morgan 185. Yeah. So, and they only lost 2% of deposits over the course of the quarter, even paying essentially nothing on those deposits. So I think that Regions is pretty well situated. They're going to stash some cash here, probably slow the roll on buybacks. And then that's probably good news. I think if there's an issue with the quarter, it's that they didn't raise net interest income guidance for the year. But I mean, I remember a month ago, even before the banking crisis hit, a lot of analysts were saying that they were concerned that they wouldn't be able to hit the net interest income guidance at that point. So the fact that they were able to reiterate that today, I think is encouraging. So I think it's good news for Regions. I think that regions should outperform the broader regional bank industry. Question is, how does the regional bank industry perform? And that's kind of the issue that we grapple with as a PM team.
Yeah, and they're showing some resiliency. I mean, stocks trading in the mid $23 range before all the banking concerns cropped up a little over a month ago. Traded down obviously quite quickly, kind of into that mid $17 range. It's really just kind of hovered between 18 and 19 bucks since then. That's right where it is right now. Pre-market up about 0.6%. So hanging in there. SLB, we also heard from.
Yeah. There's been a lot of oil and gas servicing company. SLB used to be Schlumberger. They and Halliburton are really the big two in this industry. We own NOV and Champion X in this industry. So it's a good read for those. Basically, they produced a nice beat in the quarter, and they expect free cash flow was a little bit light, and I think that's probably why the stock's trading down. But this is a more conservative team. You start listening to Halliburton, and those guys are pounding their chest. We're the kings of a mighty kingdom. And Schlumberger basically says we're a good player in an all right region. But Schlumberger came out with paragraphs and paragraphs of why this cycle is different and how resilient demand is. International offshore market, they expect to actually accelerate. It's in the early innings. They are a little bit concerned with North American land just because we don't have a ton of capital being invested in here in the United States. But in terms of international and offshore markets, which is really good for the oil field servicers because that's where you get a lot of your margin, that's just going from strength to strength. So they're really bullish on that. And I think that's probably a good read for our long-term investments in the likes of Champion X and NOV.
HCA reported stocks up. It's really kind of ripped off here a little bit. It's up about 5.5%. Good quarter all around. I mean, EPS, all the numbers you'd want to see, they kind of surpassed. Even something like pricing, where they're expecting a 3.1% decline, they were only down 2.3%. I think the guidance and the commentary are the real story with HCA, though.
Yeah, I mean, they got it up by 80 cents. And a lot of that was because they beat by $1 in the quarter. So you have that going on. Surgeries were up a lot. They were up in the low to mid single digits versus being about flat last quarter. So that was a big piece of good news. And there wasn't really much talk about nursing or staffing at all in the press release. And this is we're up probably about 50% on this since last quarter when they reported and they really got hit. And I just want to give a big shout out to our analyst, Jason Sieb, on this. I mean, this is a great case study of someone who we had an idea of what his talent was at the time and the potential. And not only has he narrowed that gap significantly, he's raised the bar substantially on that potential. And he's been really the driving force behind HCA, and it's very well represented in client accounts. And so big kudos to him on this one. And it should be a nice day for us as a result.
Big week ahead. What are you guys kind of looking forward to as you wrap up this week, look ahead to next week? Tons of earnings. What are the 2 or 3 things you guys are keeping an eye on?
I mean, GDP on Thursday is a big one. There's a lot of stocks too that we've been watching pretty closely. First Republic Monday night should be interesting to see just how bad the damage is. That could be either a huge upswing or maybe the death knell for First Republic, depending on how their deposits look. Eli Lilly, Amazon, all the big dogs early in the week, Google, Microsoft. I'm sure, Ben, you've got some that you keyed in on for sure.
Yeah, I mean, I think Visa is one that I'm very just to see where is the consumer right now, and then of course Meta's been up 100%. This last 100% that has been up in the last 6 months is all because of lowering costs. Can they get anything going on the revenue side? We did hear American Express saying small and medium sized businesses are pulling back on advertising throughout the quarter. And Meta just announced 4,000 more layoffs and potentially more to come. So I'm very curious if Meta can keep the momentum going, or if it might stall out. We also do have NOV that day, that evening. So that'll be interesting to watch as well in light of this SLB news. It's going to be an incredibly, incredibly interesting week. You thought this week was big. Next week's going to be bigger, and Tuesday is going to be Tuesday evening.
It's packed.
Yeah. So Wednesday morning, Thursday morning, Friday morning, be on those calls because we'll have some good stuff.
Yeah, I'm interested to hear from Pepsi too. I'd love to hear something other than just pricing. Just see what they're doing. I think we all kind of know the pricing story at this point. We've certainly seen it reflected with Procter and Gamble and others, but interested to just see how some of these companies are executing beyond just slightly increasing the pricing of their products.
I would say for those of you we have been investing more in Raytheon over the last number of months, and it's done okay since we've really increased our investments there. They do report Tuesday morning, so keep an eye on that. I'm bullish on the engine story there, as well as the defense story in light of Lockheed Martin's results this week.
Awesome. We'll wrap it up there. Hope you guys have a great weekend, and we'll be back Monday morning at 8:30.